Hey guys, welcome back to another video. In this video, I want to talk about a topic that I talk about all the time but is seriously not talked about enough, which is inflation, the country's U.S. national debts and interest rates, and how they all intertwine. This is a huge topic and all of it are related. This could lead to our future, people's jobs, and our financial stability. So let's talk about it. And now to my first point, which is the Federal Reserve's Balancing Act. So basically, I'm just gonna tell you what the Fed's job is before I get into any of the more important points. What the job is basically, they have to balance between quantitative tightening and quantitative easing. Basically, they have to balance the economy to be at the most comfortable state possible for the people. And right now we're in inflation, and I cannot. It's actually much harder than it seems to be able to adjust quantitative tightening and easing in the right timing. Because the best example I could give is at the start of this year, they have declared victory over inflation, but clearly that's not the case because once they want to start decreasing rates, inflation spike again. So basically, it is not as easy as it seems, even though it has been rapidly declining, could rapidly just remove all the progress just because of a few actions. So this is a very delicate balancing act they have to conduct, which is actually very stressful. And now to my second point, which is the impact on interest rates. So basically, right now the interest rate is at 5.5%, and the Fed put it there. This is to stop. This is to slow down the economical, financial flow in the economy, money flow in the economy, so that basically the economy becomes worse. Why do they want this? Because they want inflation to come down. They want prices of things to become cheaper. So basically, what are the effects of this? The simple effects of this is that on house loans and mortgage rates. For example, if the mortgage rate is at 7% and it goes down to 3%, clearly they'll buy and they'll wait until it drops down to 3%, then they'll buy, right? And then this increase of demand, it will surge inflation. Or even simply, if the interest rate is lower, then business owners will easily be able to borrow money. And when they borrow money, they get to advance and innovate their companies easier, right? And that basically will also spike inflation, employment, labor market, spend more money on employment, so on, that will spike inflation. So basically, interest rates is indirectly stopping inflation by having a higher rate. And on my third point, which is the Fed's dual mandate. So basically, the Fed, yes, they have to control the economy and the money flow of the economy. They have to control inflation. They get to decide the quantitative tightening and easing, the timing and all. But what are they actually responsible for? They're responsible for making inflation come down. That's first of all. Second of all, they're also responsible for maximizing employment. But that's the thing about these two things. Inflation and maximizing employment does not fit well. When inflation is low, okay, I can't say that. When they use interest rates to control inflation, it makes unemployment rate increase. But when inflation is high, when inflation is very high, and employment, the labor market is very strong, it will strike inflation again. So basically, it's very hard to balance both sides, because right now we're more towards a situation where labor market is strong because inflation is still going on, but at the same time the labor market that is slowly declining in this period of time because the interest rate is starting to take effect. So basically, they have to also make sure the labor market is okay. So if the labor market is not okay, let's just say they are doing really bad, then the Fed will be forced to cut rates to save the labor market. So basically, they have to make sure these two things are in the right place. And then my fourth point, which is current economic conditions and projection. So what do we know now? What we know now is that in July, the Fed's meeting in July 31st, there's a 6.7% chance that they're going to cut, which is basically practically not going to cut. September, there's a 98% chance they're going to cut. Why? Reason why is because last year and at the start of this year, they have been able to declare victory over inflation, but it was a mistake because they declared too early. And because of that, inflation reoccurred and then they lost their confidence. But now, since they have approached it carefully with enough data, they think by the time September comes, there will be enough data for them to cut interest rates. And right now, in July, they think there's not enough data for them to cut interest rates. And of course, we don't know what's going to happen in September. It all goes down to what the data say. But as far as they know, they think it's going to happen. So basically, July, it's not happening. And September, there's a high chance of happening of a interest rate cut. Because they think that it's about time and they think that they can comfortably cut interest rate without disturbing inflation. And now my fifth point, which is the long-term concern. The long-term concern for this country is the debts, because right now it's at 35 trillion and still counting, with an assumption that they will increase the debts every year by 1.6 to 2 trillion every year. That's really, really, really bad, because all of these are related. You know, when the country has more debts, it creates a worse economy in the country. So this is a long-term problem for the US, because basically when a country has more debts, right, they won't be able to spend as much on technology, on the country's advancement itself. So the country will pay less in medical advancement, they'll pay less in military advancement, they'll pay less in just society in general, but they have to pay more in just paying the debts itself and the debts' interest, so they do not get behind on payment. They're not, in the near future, they're going to need to pay more on interest than actual medical advancement, and this year they have already surpassed the military spending just from interest. So that's really bad. And basically, there's no more space for them to have any additional advancement that could make them exponentially stronger. So in conclusion, everything from interest rates to inflation to employment to national debts are all interconnected, and they're actually just one topic. To know the economy, you have to know many aspects of the economy, not just one aspect that can determine the entire economy. That don't make sense. It could come from the oil market, it can come from many different places. Well, these are just a few factors that I have personally learned that would affect the US economy in the next few months, in the course of the next few months, and have for the past few months and past year. And national debt is going to be a long-term problem, in my opinion. And in my opinion as well, September is still unclear for myself. I don't know. I think it really depends on the data. It really depends on the data. It depends on at what percentage is the inflation by September, and then there will be a clearer picture. Anyways, that will be it for this video. I hope you enjoy. I hope you like and subscribe. I hope you come back to watch another video, and I'll see you in the next one. Bye.